we have a lot of topics to go over, as we discussed. So I want to go right into a conventional loan. Conventional loans, I feel like they're kind of the gold standard of mortgages. So we'll go into the pros and cons of conventional loans. We're going to go into some of the common myths and some of the affordable loan products with conventional loans. So first and foremost, Don, what is a conventional loan? Because I have the definition right in front of me, but just based off of your understanding as a loan officer, how would you define a conventional loan?
How I would define a conventional loan is if you have more than 620 credit score, you can put as low as 3% down for a down payment, or go as high as 20 or more if you wanted to.
And we're going to talk about that as well.
Yep. And then, so the conventional, you can go as low as 3, high as whatever you want. And the credit score minimum is 620. A conventional underwriting has different guidelines compared to FHA. FHA, you have as low as 3.5 down payment. And the minimum credit score requirement is 580 to put 3%. Let's say you have less than 580. You can go as low as 500 credit score and put 10% down.
And we'll talk about that once we get into the FHA section. So like more or less for conventional, and I think just people kind of misconstrue what a conventional mortgage is. And I think it's just as simple as it's a loan that's not backed by the government. These FHA is backed by the government. USDA is backed by the government. VA loans are backed by the government. So these loans are from private lending institutions. So these are your lenders. And then they follow guidelines set by Fannie Mae and Freddie Mac, which are both two government-sponsored entities. So if you heard of Fannie Mae, Freddie Mac, they're quasi-government agencies, and they kind of set the standard for the guidelines that these private lenders follow. But God forbid someone were to default on their loan, these private lenders would be on the hook. Whereas if you had an FHA loan, USDA loan, VA loan, the government insures these loans and the potential default of the borrower.
So I'm glad you said that, because that ties into the pros and cons of an FHA loan.
Yes.
FHA being federally backed, you have that upfront mortgage insurance. 1.7% of the purchase price is you would have to pay an insurance fee. You can finance it into your mortgage, so you don't have to come out of pocket, or pay out of pocket. So let's assume you want to buy a $500,000 house. The FHA, you have a 1.7% cost for automatically right off the top. Conventional, you don't.
Exactly.
And then another con with FHA is that mortgage insurance is lifelong.
Right. Don, we're gonna talk about this all in the FHA section, man. Let's keep the audience, waiting for that section.
So conventional, I would always recommend conventional, but the drawbacks with conventional is you can't go more than a duplex on purchasing. If it was a duplex, 5% down. There are some products out there, and it's not all the time, that you can buy a triplex under conventional methods. However, it's income based, area based, so it gets a little tricky and windy. It's very demographic based, but FHA right off the bat, you can go 4 units. 3 units, no questions asked, as low as 3.5% down. I'm a person who have used the FHA product. It has one deals over and acquiring properties versus a conventional. Both are great loan products. Both are great for first-time home buyers.
Well, let's go into some of the pros and cons.
Okay.
So some of the pros, and you went over some of these points, where there's no private mortgage insurance after 20% down. So once you put at least 20% down, you do not have any private mortgage insurance. And that's private mortgage insurance is for protecting the lender in case you were to default on the loan. You stop making payments, you have foreclosure. Private mortgage insurance companies insure the lenders. So I'm going to ask you a question. You can buy this mortgage insurance out at closing, right?
Correct. Out-of-pocket expense, you can pay at closing or finance it, group into your loan.
And who can also pay for this?
The sellers, as a seller credit.
And the lender.
Oh, and the lender.
And the lender too.
With the lender credit, essentially.
So fun fact, if you're putting, let's just say like 15, 16, 17% down, just under 20%, you just paid off the closing. So you don't have to worry about it each month.
Alex, only drawback with that is I have customers who have closed previously without any lender credit. Can you believe that?
It's crazy.
So a lot of people don't know this, that as a person buying a home, your lender could also give you some credit. It's
Yes.
called lender credit, and there's not just sellers. It's just not grants or whatever, but your lender gets lender credit. I've called clients who I've closed on, and there's like third time buying a home, or this is a beach house, summer rental, whatever it may be, and they're surprised. Hey, what's this $5,000 lender credit you gave? And I was like, who gave that? And I was like, the lender. It's a lender credit. It's like I'd never seen this before, and and that will help finance your private and mortgage insurance.
Yeah. So it's always creative. There's always creative solutions, if especially have a goal in mind. And also, private mortgage insurance is typically lower than FHA mortgage insurance premium. So mortgage insurance premium is fixed, and we'll talk about that in the FHA section. But for conventional loans, it's typically lower, especially if you have really good credit. It's usually lower. So going on to the next pro is typically there's less documentation required by the underwriter in a conventional loan compared to FHA. And this is true specifically for those self-employed borrowers because, as you know, with a conventional loan, if you've been in business for 5 years or more, you only need one tax return for underwriting. But for FHA, if you're self-employed, you need 2 years no matter what. So this is, I think, a great option, especially if you're self-employed, where you only need 1 year to qualify for. Moving on to some of the cons, right? So like you mentioned a little before, is you need a higher credit score compared to FHA. And you said the minimum is 620. But there's a caveat about the minimum credit score. Why don't you tell us a little bit about that?
So yeah, the caveat with 620 credit score, just because you have let's say 622 credit score, you have good income, but your debt to income ratio, that means whatever your gross monthly pay is, divided by take 50% of it, and then you subtract away your monthly liabilities, and let's say your ratios are at 49%, even though the eligibility for a conventional loan is 620 credit score, 49% DTI. If your ratios are too high, and every bank does this, every lender does this, they run your application on an AUS system.
It's just a computer.
Just
computer saying
computerized-
yes, no, or maybe. You really need the yes every time.
Oh,
you need the yes.
Yep. And it's really a thumbs up, a green light, depending on the system. So as simple as that. You run your numbers, you run your income, everything goes under I don't know if it's AI generated, but it's definitely an automated system that looks at your income, it looks at your credit score, looks at your credit report, any delinquency, derogatory, any charge-offs. So it will spit out of ratios, and just because you have all the minimum eligibility for conventional, if the system gives you a middle or down, thumbs down, you can't go conventional. It will recommend you going FHA.
Yes. So, and you can typically, if you do have a lower end of the credit score, but anywhere under 660, so like 620, 660, if you put a little more down and if you have a low debt to income ratio, your chances of getting the green light for conventional loan are much higher. But you're pretty much golden, even if you're putting a lower down payment, maybe your debt to income ratio is a little higher to that 50% or a little closer. I think if you have over 660, you should probably get the green light.
Yep.
Good. All right. So,
and 660, 680 is the credit score you want to be to get grants.
yes.
And usually grants are tied with conventional because, again, if you have a 680 credit score, you're not going FHA unless you're buying a multifamily, but the grants won't cover anything more than a duplex anyway. But
Right. So another con is you're required to put more down if you're not a first-time home buyer compared to FHA.
correct.
So you can explain this a little as well, but if you're not a first-time home buyer, you have to put at least 5% down. But if you're a first-time home buyer, you can put 3% down, which is actually technically lower than the FHA minimum.
Oh, 100%. To be honest, a FHA 3.5, you don't forget, you still got to add that 1.7.
Yeah, that upfront mortgage insurance.
So you're really putting a 5.5, 5 points.
Now, the difference is you can finance that.
You can finance it, but it's still part of the loan.
Correct.
But yeah, it's still higher. 3.5 is still higher than 3.
Right.
And if you don't finance it, and it's out-of-pocket expense, then you're looking at a 5% versus 3. And then lifelong mortgage insurance with FHA versus conventional will drop at 20% down or 80%. Or 20% loan to value.
Correct. So last segment for conventional loans. Well, not the last segment. We're also going to go affordable loan products, but let's go over some of the common myths. Common myth one is you need 20% down to buy a home.
You know how many? So I feel like don't want to say this on air, but I feel like there's a lot of realtors out there that has the old information that tells people, oh, you need 20% down to buy because you're going conventional. But that's false. You can, again, like what you said earlier, you can go as low as 3% down if it's your first home. And do you know what first-time home buyer is defined as?
No, explain.
First-time home buyer by the banking world or the mortgage world defines as if you bought or sold more than 3 years. So that means if I bought a house, let's say 6-7 years ago, and I sold it 3 years ago, I'm qualified for another.
Right. Your first time home buyer again. Yeah. That 3-year time period is passed.
So every 3 years, I could be a new first time home buyer.
That's awesome.
Or you can get another conventional loan. Again, this is up to manual underwriting discretion. But let's say your job changed. Now you have 2 kids versus maybe no kids before. Now you need to move to the neighborhood where you need better schools, maybe just 30 miles away from your current home. You could, again, qualify for a first-time home buyer, 3% down. So it's a myth, common myth. Everyone thinks because back in the day, your parents, your uncle, someone you know in your family bought a house putting 20% down. Yes, putting 20% down sounds crazy, but back then when houses were like $200,000, it's much easier to do.
And there's a lot of misinformation out there. So that's why come to Loans Incorporated YouTube page. We'll tell you everything.
Yeah, we'll give you the most updated information on Loans Incorporated page.
Yep. Let's fly through these next parts because we have a lot of topics covered today. You need perfect credit. As we went over, minimum credit score is a 620. If you have some lates, some things that are on your credit, as long as your FICO is above a certain threshold, like we say, you don't need perfect credit. Conventional loans are only for primary residences. That is a complete myth.
You could, again, do a second home, 10% down with conventional. You can do investment, 20%.
Yep.
But yeah, this is why, to go back to our topic earlier, before you start looking at homes, if you have the concept of buying a home one day, talking to a mortgage officer is very important, because especially at Loans Incorporated, we will go over not only the steps and the process, but we'll give you different scenarios on how to structure your loan for the purchase you want or need. And every client, every case, every scenario is different. It's always case by case. So you really want to talk to an experienced licensed loan officer to guide you in the right way, to get you the right loan product. There is no one loan that fits all. There is conventional loan products, but that has affordable, like Home Possible, Home Ready loan products within the conventional categories. And sometimes FHA is better if you're a recent graduate. A lot of people who come out of school think, oh, I can't get a loan because I don't have a 2-year work history. Another common myth is you need 2-year work history. Me and you both have done loans for traveling nurses. We both have done for recent graduates. I have family members who graduated like 6 months ago that are homeowners. Why? Because FHA allows you to be a recent college graduate or any kind of graduate.
Conventional as well.
Just a working professional. Yeah. If you can prove that you're in school for the last year, 2 years, and you just graduated and you're now working a full-time job, that's all you need. You don't need work history. You just need to show professional history. So going to school, again, that's when an FHA loan product is better. You could be a perfect candidate with 800 credit score, having 20% down, but conventional, you at least need that work history.
Yep.
With FHA, the workaround is being in school.
Yep. So another common myth is conventional loans are harder to qualify for, which I don't think they're any harder or easier. I think that FHA, calling for FHA or conventional are probably pretty similar in terms of getting approved. I actually think conventional loans can sometimes be easier to qualify for, and not because of the debt to income ratio or some of the other requirements compared to it. If you have a good credit score, good debt to income ratio, not even a high down payment, I think that they're easier to get approved for.
So in my experience, I've seen it being easier if they have some kind of assets. Let's say you have like $20,000 in your 401k or your $30,000 in your brokerage account. So having some kind of assets in your, because a bank wants to see that you have reserve savings. You don't need to touch this money. You can just show that, hey, in my 401k, I have $20,000 sitting there growing. Great. We could put that in your assets, put that in your underwriting system. And again, you could be a 620 credit score person, just about 2 years of work history. But if you didn't have that asset, you'll get refer on your underwriting, manual automated underwriting. But if you now have substantial amount of assets to show as reserves, you might get the green light.
Good.
Again, these are not things that you as a client can do on your own. People always, I've been checking my credit score on Credit Karma. I know what I'm at credit score wise, or I know what I have in my assets. But no, a hard pull from your lender, running it through the automated system, putting all your numbers in, what you have in your assets, your income, your debt, that automated underwriting system, which only a lender can get to you, is really the first line of defense or first line of offense on buying a home. We can do all the math at home, but that math ain't mathing right until you talk to a lender and because at the end of the day, the money's coming from the bank. The bank's automated underwriting system, manual and automated, needs to give the thumbs up, needs to give that green light. And again, there will be no charge to you as a client or as a borrower for any of these services.
That's correct.
At Loans Incorporated, you come to Loans Incorporated, you want to get a pre-approval, pre-qual, you want a loan officer to look at everything start to finish, so a lender's not dropping the ball after going under contract.
There's no application fees, no junk fees.
Nothing.
No.
It's all at our cost.
Last common myth, we'll touch it real quick just because we have so many topics to go over, is PMI lasts for the life of the loan. That's not true at all.
Not unconventional.
Not conventional.
Nope.
No.
Nope.
That falls off once you reach 78% loan to value automatically. When you hit 80%, you can request it from the servicer for it to be removed.
So basically, let's say you buy a house at $500,000, putting 10% down. So your loan is $450 loan size. Once your house value gets to $550 and your loan amount gets at least a little bit lower than that, if you divide your loan balance over what your appraised value would be or its estimate on the house. If it's at 80%, you can call your loan bank and be like, hey, I think it's at 80% value. Yeah. If it's at 78, it should automatically fall out.
Yes.
Again, these are stuff that you should be talking to a loan officer to help you guide you in the right way.
We'll guide you all the way through it. We're your loan officers.
So. Can I interject real quick? Talk about something, that a strategy that a client and I came about today. So a client called saying, hey, I don't know if I should put 3% down or 20% down on a home. I was like, all right, let's figure out what would you do by not putting that extra 10% or let's say it's extra 15% down for the loan. He's like, oh, I just want to leave it in the bank. I was like, he's like, he was saving up that 20% to avoid the PMI. He has great credit. His PMI when I ran on the system was $80 a month. At most, $900 a year, $920 or something, $960 for the year. So I was like, hey, you can spend $960 a year on mortgage insurance. Just put 5% down, and that extra 15%, put in a high yield savings account. Put it into ETFs. Right now, high yield savings are giving you 5% return. Any ETFs are giving you on average 7 to 12, 13%. So he's a client that has great income, great savings. He didn't know what to do. He talked to me and we came up with an idea. I was like, let's reinvest the money and put it into anywhere else. You're only coughing up $920, $980 for mortgage insurance. So, and that's also a tax write-off, a tax deduction. You have tax deduction for about $1,000, a little less than $1,000. You reinvest your money into something. And people always think that the mortgage insurance is for the life of the loan. No. Forced depreciation. Within a year, with some kind of minor renovation that we all will do once we move in, your property value will appreciate. You call the bank and say, hey, my property appreciated. So without putting 20% down, you let time do its thing. It's called forced depreciation. And the bank has to drop off that mortgage insurance.
Awesome. Oh, that was great. Well, let's go into some of the affordable loan products with a conventional loan. So the first affordable loan product we want to talk about is Home Possible and Home Ready. So the key with Home Possible and Home Ready is you have to be at 80% AMI, area median income, or lower. So the way you can tell whether or not you're at 80% or not is a tool called the Fannie Mae AMI lookup tool. You can find this right on Google. Also, Freddie Mac has a tool through the same search criteria, and this is just through Freddie Mac Home Possible. You go ahead and you Google the address of the property where you're buying, and it tells you what percentage you have to be at or what salary you have to be to be at 80% AMI. Now, if you're over the 80% AMI, unfortunately, you don't qualify for this program. And we'll go over the benefits in a minute, but you have had clients, especially in more high-cost counties. So what are the differences between if you're in a regular average cost county compared to a high-cost county? What happens with Home Ready or Home Possible?
So what you asked was the Home Possible, Home Ready. So I'm using 19115 as an example because I do a lot of loans out of that zip code. The AMI for that neighborhood is 114,000.
That's 100% AMI.
Correct. And then the 80% of that is about $92,000.
Right.
So the 80% is the $92,000 is the threshold you need to be or below.
Now, what about if we go up to like Bergen County or some of these areas in North Jersey? That goes up to another threshold.
Yep. I believe 1.6. Don't quote on. Go
about
quote
120, right? Somewhere.
Yeah, 120 on the 80%. Then I'm always looking at the 100% value. But it is definitely
go
higher.
Up to 100% though in those counties.
Yep.
So if you're in a high cost county, you go up to 100%, and I think regular is 80%.
80%. Yep.
Yeah. Okay.
And this changes, and the income limit is also changing every year. So that's why you would want to go on their website, type in the zip code, or if you know the address, type in the address. Find out what that year's income limits are for that specific county. It varies from North Philly to Bergen County. It varies from South Philly to like LA. It doesn't matter where you're in the country. Look up on that tool, or again, talk to your loan officer and ask them, hey, what income limitations do I have to get qualified for these affordable conventional loan product? And here's another strategy that Alex does, and I really appreciate it for Alex for doing this with his clients is, if you have two people on the application applying for a loan to buy a house and they want to qualify for this affordable loan product, if one person can carry the entire note of the mortgage, there's no point of putting two people on the loan. You can put two people on the title, so both parties have rights on the property, but one person's carrying the note, they'll qualify for the lower rate. This is great for married couples because, the chances of them staying together, keeping the house, mortgage paid and all that is much statistically higher. But yeah, so it's a great opportunity. If you talk to your loan officer, strategize that way as well, if one person can carry the note, the mortgage, the chances of them qualifying by themselves for that affordable loan product is much higher than having two people.
Yes. And let's go over some of the benefits of Home Ready, Home Possible. So biggest benefit is lower interest rates. So
almost 0.5 difference.
Yeah, almost a half a point difference in the interest rate if you can qualify for Home Ready or Home Possible.
That's about $200 a month savings on a $500,000 house.
And you can still go as low as 3% down on a conventional mortgage.
And I think the mortgage insurance is cheaper.
The PMI is lower
by a couple bucks.
It is, yes. It is lower on Home Ready, Home Possible.
So overall, it's a great product, but not everyone qualifies.
Correct.
Especially if you're married, applying jointly to buy a house together, chances are you're not going to qualify because your income is just going to be too high.
Yeah.
But again, a great loan officer or an experienced loan officer knows that, hey, you don't have to have both people on the mortgage to qualify them, and to get them the best rate, have one on the loan, both on title, everyone's happy.
Correct. Next program that is an affordable conventional loan product is the One Plus. So the One Plus loan product is a 2% grant from the lender. So if you're putting a minimum of 3% down, it's almost as if you're putting 1% down because that extra 2% is being covered from the lender. So there are some stipulations with this program. So there is a grant floor. And this is $2,000 for clients between 50% AMI to 80% AMI. So if you're within that threshold, you can get 2% covered up to $2,000.
Yep.
And then there's a grant floor for clients below 50% AMI. That's going to be $2,500.
Yep.
So One Plus is a great program. I've closed some customers with the One Plus product. It definitely is good. If you're trying to get into a property, you don't want to go with other down payment assistance programs. You want to stick to a conventional program. You want to still keep as strong as an offer as possible with a conventional loan, because even though I don't 100% agree with it, sellers consider conventional pre-approval stronger than FHA or other government-backed loans.
Yep.
And then just want to touch on the conventional home rate break program. So this is another affordable conventional loan product. Have you heard of this one yet?
No, actually, I have not heard of this one yet.
So this one just came out. So the home rate break is a lender paid 2-1 buy down. And this is applied to all eligible home ready purchase loans. So just like the criteria we talked about for home ready and home possible, you have to meet the area median income limits. There's also a loan amount limit, and that's $350,000. So for this program, so all this is saying, let's just say the interest rate is today 6.5%. So the effective interest rate in year one will be 2% below the interest rate. So if it's 6.5, year one, it'll be 4.5. The effective interest rate in year two will be 1% below the interest rate. So then I'll go up to a 5.5 for year two. After year three, the interest rate will return to the rate at where it started, 6.5. So it will go to the 6.5 when you initially lock the loan. Now, here's the best part about this program. There's no prepayment penalty or restriction on prepayment. So you can refinance this home at any point. So if the rates come down and it's a good time to refi, you're way below that 6.5, then go ahead, pull the trigger and do it. So I think it's a great product. If you're banking on the rates coming down, you get the lower rate now. So you have a more comfortable payment at 4.5%, whatever the rate is. And then if they come down at any point, just refi.
And correct me if I'm wrong. I heard with this rate break or the 2-1 buy down that sometimes the sellers can pay for this and seller's credit.
So yeah, on a regular buy down, temporary buy down, the seller can pay for this. Actually, any party out besides the borrower can pay for this. So this program specifically is the lender is covering that for the person. But if you wanted to go with, let's just say, the 1+ product or a regular home ready product, you can actually just do home ready with a low rate, really low market rate, and then have the seller give you a credit to do a temporary buy down. So with the home rate break is just saying the lender is going to buy the temporary buy down instead of the seller or any other not any other interested party besides the borrower, if that makes sense.
You know, it's crazy that we have been able to help families get into homes with the buy down programs. Especially with the grant program, I was able to combine the Philly First with the 1+ as almost with just $1,000 out of pocket. I've done 3 deals where the client came with just little over $1,000 to buy a $300,000 home.
Yeah.
And there's been a handful of deals I've done where borrower did not pay more than $9,000 for a $400,000 home. Rest was all covered between lender credit, grant, and the assistance program.
Yeah, that's some awesome stuff.
In today's market, in 2024, especially since 2021, if you actually have the mindset of buying a home, it can be done. More than having the assets or the funds to buy a home, there's tons of great program out there. But it's really, in today's market, you can definitely get a home with honestly less than almost $1,000 out of pocket.
100%, especially if your market is affordable, like Philadelphia.
Correct.
Yeah,
especially if you qualify for if you're looking for homes in the 350 range, you can definitely get a home in today's market.
100%. And then last point on conventional loans are jumbo loans. So jumbo loans, these are any loans that are outside or surpass the conforming loan limits. So 2025, the loan limit has been announced that it will go up to $802,650.
Okay.
Which, when I first started in the business over 5 years ago, it was still in the 500s.
Yep, I remember that.
Yeah. So it's gone up quite a bit since we've been in mortgage specifically.
$300,000 in loan. That means you out of 8, you suppose 850 for next year.
802. 650.
And you could still put 3% down.
You can still put 3% down.
On
Isn't that incredible?
802, wow, that's wild.
Yeah. Now, I mean, you have to be making the income to float that. So it's still amazing though.